Bank. Let me just disconnect and now come back to the bond yields. The bond yields are now standing at a 6-month low. The 10-year bond yield is at 7.13, a level we have not seen since the since 27th July last year. That makes it a 6-month low. And the reasons for this is exactly that. The CPI index coming in at 5.69, which is way lower than what even the Reserve Bank forecast. The Reserve Bank's forecast for the full quarter was 5.6. Now the quarter is running at 5.4, October, November, December. And then there have been other things that have also been positive. One, the US PPI index has come in minus 0.1% for December. The market estimate was plus 0.1% for the month of December. We have been seeing a large amount of foreign fund buying of Indian bonds. We talk a lot about equity funds, but bond funds actually bought $108 million worth of bonds just on Friday. That also has pushed down yields and pushed up prices. And the big positive news for the bond markets is also that this week, the state governments are going to borrow only 19,000 crore of bonds. The expectation was that the borrowing would be some 21,800. So even compared to that, the markets are a little happy that state governments are not borrowing as much as was originally expected. So we have a huge bond rally in the markets at this point in time. And like I was saying, two brokerages, two banks, State Bank, Citi India, as well as ICICI Securities primary dealer, have both called for a likelihood of the Reserve Bank and the MPC changing their stance from withdrawal of accommodation to probably a neutral stance as early as February. It's not their base case, but they just point out that there is a very good likelihood that the Reserve Bank changes its stance because inflation is almost coming in regularly below expectations. So that explains the rally, in the bond market rally. And that's also fueling a banking sector rally in the equity market.
Latha, we could all do with some more rallies now that we've seen a big rally already in the equity markets. Now it's time perhaps for the bond prices as well. Take a short break, come back, get you more on the markets and individual stocks after a lot of macro data that we contended with this afternoon.